Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you off course to make it actionable, understandable, and clear. What a week. And therefore, what a show. We're going to be looking at a lot of Wall Street Journal, some devastating data for long-term investors. I'm going to scare you a little bit. And we may talk about tariffs. We may not. We'll just see if we have time. But 3 articles. First one, we're going to look at leveraged exchange-traded funds and how dangerous they are. We're going to take a look on the personal side for 5 folks. We're not going to look at all of them, but the Wall Street Journal has 5 profiles identifying how these folks are playing. They call it the market. And we are going to try to take captive our thoughts and make them obedient to the truth of investing and see what we can learn. We're then going to look at harrowing data on just how bad it can get for investors. I find this can be instructive for my American listeners. Bienvenidos a mi listeners in España. But for my American listeners, we can get a little comfortable. So I'm going to scare you a little bit, make sure you really want to be an investor. And then we can talk tariffs a little bit as time allows, because today, this has been recorded on Thursday, Trump announced tariffs of 25% on imported vehicles. This is the beginning or kind of the midpoint of all these tariffs, but we'll talk about what it means or doesn't mean as an investor. But at the top, article by Jack Pitcher. Headline, billions flowed into new leverage ETFs last year. Now they're in free fall. Subheadline, Wall Street's newest roller coaster ride, the leveraged single stock ETF is plunging. So we'll do a little definitional work. ETFs, are these exchange traded funds. They trade like stocks throughout the day. So they're kind of a cousin of the mutual fund, very similar, but different from mutual funds. Mutual funds will trade one time at the end of the day based on their net asset value. The exchange traded fund trades all throughout the day, based on there are market makers that ensure that the trades go off pretty close to their net asset value, but not always perfectly on it. So in this instance, what folks were doing was to amplify returns. This is always scary. They should always, red flag. To increase their returns, they were, instead of just buying stocks, they were buying exchange-traded funds that bought the stock and then borrowed a ton of money to increase the return, which of course on the downside hurts a lot. I'll give you some examples. A company called MicroStrategy. You may have heard of this group. They basically bought a ton of Bitcoin, and that's effectively what dictates the value of the stock. As Bitcoin goes, so the stock goes. Previously, they were a software company. These companies, these funds created a ETF that gives folks twice the exposure to MicroStrategy. I mean, hey, if it goes up, MicroStrategy goes up $1, you're up $2. But conversely, you go down. So this ETF is down 83% since its high. Another one for Tesla is down 80%. They then quote someone on on a Reddit investing forum, says, "I'm sick to my stomach," because they bought at the top. So it's easy to kind of say, oh, how could they do this? Chuckle, chuckle, chuckle. But on the way up, it is very difficult to turn this stuff down. The largest one of these funds is a $22 billion with a B ProShares Ultra Pro QQQ. It aims to generate 3 times the daily performance of the NASDAQ 100 index. So NASDAQ 100 being a tech-heavy index. Guess what? This has been a disaster. So even though the NASDAQ can recover from its drawdowns, this fund does not. So the NASDAQ 100 has risen about 20% since the end of 2021. This fund that offers this leveraged exposure is down more than 25%. The fund hadn't recovered from its steep losses that it suffered in 2022. This is the dark side of leverage. It yes, amplifies the upside, kills you on the downside. It violates so many of our rules of cost low, investing simple, time horizon long, So strike, strike, strike. However, what this article explains is people are showing up in droves. So MicroStrategy, that effectively Bitcoin company I told you about that holds Bitcoin, people are throwing huge money. There's been a big drop in these funds. They're quote unquote buying the dip. They are trying to double down. I'm warning you, listener, don't do it. Keep your time horizon long. We then go into a Wall Street Journal article by Joe Pinkster and Dalvin Brown. Headline, how 5 investors are playing the market chaos. Among individual investors, it says strategies range from shifting into treasuries to buying up more stocks. I'll give a summation. I'll kind of give you the answer before I give the test. In just about every one of these examples, the investors are overthinking. That is possible. They are thinking way too hard about investing and making investing much harder than it needs to be. The article explains, and we'll talk about tariffs. President Trump's tariffs and government spending cuts have prompted some people to question the standards, set it and forget it investing. We're always questioning. They think it's dogma. We're just, Luddites over here, just setting and forgetting. Ostrich investing, which I love. We'll give an example here. Mr. Aaron Hilton, 28 years young. He's doubling down. He says, believe it or not, I even think this is not best for him. What he says is, quote, I feel like this is the first real test of whether or not I run at the first sight of trouble, said Hilton, a military officer based in Hawaii. So far, I'm sticking to the plan. If he thinks this is the trouble, whew, I'm the old man here on the podcast. I think this is nothing. What he's doing, though, and I think this is not good, he's trying to double down. He's trying to invest more right now. Well, what, invest more? I mean, how much has changed? Not a lot. Over the last year, the American stock market's up quite a bit. So I don't fully appreciate why someone feels like this is this is just a little bitty dip. Little bitty nothing dip. But here he goes. He wants to amplify those returns. We always want a little more. We've got Andrew Gouda, 37. He doesn't like what he's seen in the U.S. economy. He's a pharmacist in Clearwater, Florida. He used to be invested in U.S. stocks, but he says after the markets wobbled in February, check this out, he shifted heavily into gold, silver, and international markets. So he's now 55% in metals and mining and 45% in international equities. He walked away from American equities. He is skeptical that the U.S. stock market can continue to rise. And I quote, and this is deadly. What's happening on the ground for middle-class Americans just doesn't line up with what the stock market is doing. Now, we can really trick ourselves into thinking that we see things others don't. So this gentleman here does not have a high enough view of the stock market and a high enough view of efficiency. The data's out there. He doesn't see anything that the market doesn't see. But we can deceive ourselves to the upside or downside. Some people say, the Main Street's doing better than the stock market, therefore I'll invest. No, none of this is actionable. So this is going to be a huge problem for him. If Mr. Gouda were to walk in my office, I would say, okay, we're out of stocks in the U.S. Are you ever going to get back in? And what I suspect you would hear is a long story with a lot of ifs, ands, or buts, and maybes, and gut feelings, and maybe I'll jump back in when there's a dip, and blah, 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 blah. He will certainly do worse over his lifetime due to this jumping back and forth to asset classes. Even if silver and gold and international stocks do well over the next 5 years, this business of jumping in and out rarely is won. Rarely. And here we go. This is a good one. We're going to skip here to the very end. Chris Ullman, a 61-year-old communications consultant in Alexandria, Virginia, he sees a buying opportunity. So this is another one of these buying opportunity, folks. This is what I see more of, and I want to challenge this thought process. Okay, this gentleman, Mr. Ullman, he put $20,000 in an index fund, tracks the U.S. stock market, which is 3 times more than the amount he normally puts into his retirement accounts. He's quoted, I bought on the dip. Ullman said. If you're in your early 60s, you're about to retire, you should be excited. He's overthinking it. The dip? How does he know it's the dip? You know that a lot of people bought the dip in 1929? A lot of dip buyers. It kept dipping for 3 years. We think way too much about our prophetic powers to think this is a dip. And oh, by the way, stock market's up about 80% over the last 8% over the last year for American markets. So the dip, I mean, I know what he's saying. He's saying we in the last, couple weeks it's been down, but I just think we're making this way too hard. So even the dip buyers, although it's better than nothing. I actually think if we were to rank the errors, I'd say the dip buyers are they're going to be just fine. They're not changing their asset allocation. The asset allocation, folks, that's probably the greatest error. And they highlight someone who did something good. There's a physician who just isn't Vijay Gandivia, 59, isn't budging. I don't define risk and volatility as the same thing. Volatility just means up and down. Risk means you're actually losing money. Well, yeah, I think that's right. Well said. So he's sticking with tried and true index funds and just riding it out. So you see all these different people. You see one who did pretty well, but most of them are violating some truth in investing that is going to be incredibly costly. One little move of a rudder for people on their finances, all of their cost cutting and couponing and wringing of hands over expenditures, it's for naught. They've done the most expensive thing, which is to make errors in their investing. That's really expensive. Very, very expensive. We've all done it, haven't we? We're no better. We're just seeking to do our best here. And then tariffs, a little tariff talk. No article. You've probably read 50 of them. I just want to make the note that, and this is today, General Motors and Ford are down. Tesla is up. Who has more domestic manufacturing? Tariffs are not actionable for you as an investor. The market is vastly more efficient than you ever dreamed. So whenever you think, oh, wow, okay, tariffs are coming, I'll sell stocks. When the tariffs remove, I'll buy stocks. It's a misunderstanding of the way markets work. Everyone else knows that as well. In fact, there are folks who have incredible armies of analysts and increasingly AI and AI agents who are combing the same data you are and have far greater access than you and I do. And they aren't quite sure the impact of tariffs. That's why the market moves as much as it did. So don't get into the mindset that you're going to somehow play the political winds with your investing. It does not work. It is not controllable. And then in closing, we enter one of our favorite areas, which is the game show. So you think you want to be an investor. And everyone thinks they want to be an investor. I think I want to be an investor. Hasn't it been great as an American? We haven't lost a war on our home soil. We've gotten close. War of 1812 was very close. And I understand those in the South consider a loss, but let's face it, the Union won. America is here. I will say, though, Charleston, South Carolina, a lot of people got wiped out in the Civil War. That was the city where Lincoln decided to put everybody's property up for sale as punishment. So those investors probably did get wiped out. I don't have data for them, but you could buy your property back, but no one had any money. So they got wiped, Charleston, South Carolina. But I want you to listen to these other instances where investors got really, really hurt. United Kingdom, 1901 to 1921. Let's say there weren't index funds like that. Let's say you bought the index for the United Kingdom in 1901 and you looked up in 1921, you're down 46%. 20 years of investing, you're down 46%. You had World War I followed by the Depression of 1920. France has, I don't know how people even wake up in the morning in France. Listen to this. 1906 to 1926, you're down 75%. World War I. And they had a currency crisis. How about this? 1930 to 1950, you're down 93%. Great Depression, followed by World War II, and then German occupation. How about this? France again, 1961 to 1981, you're down 48%. just weaker growth, currency declines, high inflation, just kind of run-of-the-mill, blah, blah. How, I imagine they don't sell many stocks for the long run books over there. Jeremy Siegel's work. I bet it's not a hot seller. Spain, 1962 to 1982, you're down 59%. By the way, the source for this is Changing World Order by Mr. Ray Dalio. Italy, again, I don't know how you get up in the morning as an investor. 1907 to 1927, down 84%. 1928 to 1948, down 87%. What? 1960 to 1980, down 72%. Japan, this is a long one. I don't know how the Japanese invest. 1928 to 1948, you're down 96%. Now, you want to hear some real wipeouts? 100% wipeouts? China, 1930 to 1950, you're down 100%. Asset markets closed during World War II and then were destroyed. You're done. You got nothing. Russia, 1900 to 1918. Russian Civil War, destruction of financial markets in totality. Done. Yeah, the markets are done. You have nothing. So I think you should seek to invest. I think you should seek to be an optimist, but you should do so knowing you are taking a risk. There is no free lunch. So if you think, oh, great, I'll just be an investor and I'll get these returns and they must come my way. That has not been the case for everyone in every part of the world. And in fact, there are instances that even in our own country, Charleston, South Carolina, you got wiped out. So we should always remember this is not some surefire game you're playing or I'm playing. We should not squeeze the bunny too tight, as they say, not squeeze the golf club, not presume that somehow by keeping our costs low, investing simple, and time horizon long, we will certainly get great returns, because that's not how it ends, is it? It's going to give us the best shot on our investing journey. That's all we can do is put the probabilities on our side. We can't wring out returns and manufacture returns. Returns aren't waxed to be molded. It's not a widget to be manufactured. Returns just are. You'll get them or you won't. So let's control what we can. Let's keep those costs low, that investing simple, and that time horizon long, because that's what's going to give us the best shot on our investing journey. Until next week.